Welcome back. You're watching Commodity Champions, and week after week we have been tracking this, and there is still no stopping the gold rally. Prices have breached $3,800 per ounce mark after surging 12% in the month of September. This makes the yellow metal's strongest monthly performance in 14 years. Silver prices, in the meanwhile, are trading at a 14-year high. Prices have jumped 65% so far in 2025, also headed for the best yearly gain in 10 years. The growing expectations of more U.S. Fed rate cuts in the next two meetings this year have boosted demand for the safe haven yellow metal. Prices also are rallying over the possibility of a U.S. government shutdown. If no deal is struck on a spending bill by 1st of October, the U.S. will have its first shutdown for nearly 7 years. On Monday, President Trump met congressional leaders, but there was little progress. So how soon could gold hit $4,000 per ounce mark? Well, for joining us to discuss all of that is Daan Struyven. He's co-head of Global Commodities Research at Goldman Sachs. Dan, hi, thank you so much for joining in. First of all, your sense on the U.S. government shutdown. Is it coming? And if it is, the impact on gold that you see?
Thanks so much for having me, Manisha. So at this point, I think financial markets and prediction markets and our U.S. economists think that a shutdown is somewhat more likely to happen than not. Historically, around government shutdowns, safe haven assets such as gold tend to benefit somewhat. You also tend to see a somewhat weaker dollar. But more broadly, though, I do think that uncertainty about macro policy, uncertainty about geopolitics, is the backdrop against which gold prices have risen very sharply. And we think more gains are ahead. We see the gold price exceeding $4,000 per troy ounce from the summer of next year onwards. And I think the risks are skewed towards reaching that target earlier than our baseline.
Dan, sorry, I missed that level. Did you say 4,000 or prices above that?
So yeah, our base case is that you hit 4,000 in mid-26 and then exceed 4,000 in the second half of 2026.
And what are you looking at in sense of gold prices by the end of 2026 then? Once that 4,000 is crossed, what levels are you looking at?
Yeah, around 4,300, yeah.
Dan, there also are various reports suggesting that by the time it's 2028, 29, we could be looking at 5,000, 6,000. Do you see that linear progression continuing in case of gold prices?
Yeah, so our current price forecast ends in December 2026. But to answer your question, I think we first need to figure out why gold prices have risen so much, essentially since 2022. And the main driver really is the fivefold increase in the buying purchases from central banks. So specifically, central banks are now buying at a roughly 80 tons per month monthly purchase. That is about 5 times faster than before 22. What happened in 2022? Russia's central bank's reserves were frozen, and as a result, EM reserve managers across central banks in the world realized that the truly only safe asset when you hold it in your domestic vaults is gold. And so central banks have been adding gold, and based on our estimates, several important Asian and emerging market central banks are still underweight gold, still have significant room to increase the gold share in reserves. And so we have estimated that central banks will likely to continue to buy gold at a rapid pace for the next 3 years. That has been the main driver of the rising gold prices. If that continues, I think it's quite plausible that gold prices continue to rise even after the end of our forecast horizon in late 26.
All right. Dan, how are you looking at silver also? Because silver has outperformed gold, and silver, apart from safe haven, is also an industrial metal, and that is where the major demand seems to be coming in from. And then add the deficit story to it, and you have a perfect mix. From where we are standing, do you see 50 taking off, and what are your targets for this one?
Yeah, so we don't forecast silver prices, but what we have seen basically since 22 is that the gold-silver price ratio, which historically is in sort of a 45 to 80 range, has broken out of that range. At the moment, despite the outperformance year-to-date of silver, gold prices are still just about 80 times higher than silver prices, above this historical 45 to 80 range. Why have we broken out of this range? The main reason is that central banks are buying gold at a much faster pace to hedge against geopolitical shocks. Central banks are not buying silver because silver is more ample and less precious. And therefore, we do think that this higher gold to silver price ratio is structural and is here to stay. That said, if investors rotate from the gold market into the silver market, you can have a lot of upside to the silver price. And that's what we're seeing year to date. If investors look for the catch-up trade of silver, or for that matter, other precious metals to gold, you see a lot of upward pressure on demand for silver and therefore the price. I think the main intuition is that we estimate that the silver market is about 10 times smaller than the gold market in terms of the value of all the metal that has ever been mined. And so you only need a relatively small diversification step out of the gold market into the silver market to cause a lot of upside. And so the ETF inflows, investor inflows in silver have been very strong, and there is potentially more room to run. That said, structurally, the main reason we are bullish and have been bullish gold, and gold remains our favorite long commodity, is central bank buying, and that's a gold-specific story, not a silver story.
Dan, come in on the de-dollarization part of it, because you mentioned central bank and you mentioned buying as well in sense of ETFs, but do you see de-dollarization as a major part as well when it comes to gold buying?
I do think that diversification has been a main driver of the gold rally. So far, central bank reserve diversification out of Western treasuries and government bonds has been the main driver of the gold price rally. That said, over the last few months, we have also seen some indications of what I would call private sector investor diversification. For instance, this month, we have seen a roughly 100 tons inflows in gold ETFs. That's more than what our traditional models based on falling interest rates would predict. So we're seeing more inflows into gold ETFs than you would predict. And that's consistent with investors in an uncertain geopolitical and macro environment looking for diversification opportunities. And I think the main reason that we see significant upside to our 4,000 mid-26 gold price target is precisely the possibility that private sector diversification continues. The key intuition for the large upside risk to gold prices from private sector diversification is that the gold market is quite small. If you, for instance, compare the value of global gold ETFs, it's about 100 times smaller than the value of outstanding US treasuries, 200 times smaller than the value of the US stock market cap. And so you only need a very small diversification step out of, for instance, US treasuries or out of US stocks to get the next giant leap for the much smaller gold market.
I get that. Dan, are you looking at dollar declining from here? That would explain the kind of run-up that we're looking at in various metals. And as you said, it's not just gold and silver, it's platinum, palladium, even copper, zinc, aluminum are trading at a multi-month highs right now. Is dollar somewhere to be seen as a catalyst for this?
Yes, so our FX strategists, they do expect dollar depreciation to continue. They, for instance, estimate that the dollar is about 15% overvalued. The main reason to expect somewhat additional dollar downside is that the incredible outperformance of the US economy and US financial markets over the last 10, 15 years in our forecast diminishes somewhat. US outperformance looks somewhat less exceptional in our forecasts. If you combine that with a large current account deficit and overvaluation, the base case is that the dollar depreciates. That tends to be supportive for commodity prices, because many commodities are denominated in dollar, and so you make commodities more attractive, cheaper for non-US buyers when the dollar depreciates. In the case of gold, though, we do find that the main reason that gold tends to rally when the dollar depreciates is via the lower US interest rates channel. When the Fed cuts rates, all things equal, the dollar tends to depreciate and ETF flows into gold rise because the opportunity cost of holding gold and non-yielding asset rises. But yes, I would say big picture, a softer outlook for the dollar is a supportive backdrop for commodity demand, including gold, but also industrial metals such as copper.
Dan, you mentioned the interest rate cuts, and that really was my next question, because one done and two to go this year?
Yes, so we have the Fed indeed cutting 2 more times by 25 basis points towards the end of this year, and then an additional 50 basis points in 2 steps by mid-26. So if you do get another 4 25 basis points cuts from the Fed, it's another reason to expect gold ETF inflows to rise, and it's one of the 2 key drivers of a bullish gold call. So cyclical support from Fed cuts and a structural support from central bank buying.
Then are you also looking at base metal prices? Because we're looking at copper at a 2-month highs and zinc and aluminum at 6-month highs as well. While China, of course, continues to play a bigger role here, the markets do believe that the demand scenario from here would improve. How are you looking at the segment?
Yes, so copper prices have rallied significantly. We're now above 10,000. I think the recent main catalyst for the rally is mine supply disruptions. The second largest mine in the world, saw an estimated 1% of global supply drop in production, both in 25 and 26. Big picture, we do think that the copper price outlook looks pretty constructive over the medium term. We have the copper price, approaching nearing $11,000 by late next year on the back of strong electrification demand, support from easing financial conditions, and somewhat constrained supply. And last but not least, we also expect stockpiling, strategic stockpiling from governments to boost some upside to copper demand. That said, we don't expect copper prices to go to 12,000 or even higher, because there are some factors that limit the upside price pressure on copper. For one thing, we think the market is still in a slight surplus. And then second, when copper prices rise too much relative to aluminum prices, when the copper to aluminum price ratio sort of exceeds a factor of 4, you tend to see switching in terms of demand away from the copper market to the aluminum market. And because we expect strong aluminum supply from Indonesia, we do think that there are some constraints, there are some caps on how high copper prices can go, despite a pretty constructive demand environment.
All right, Dan, thank you so much for joining in. And that's a lot of detail that you have given to us in sense of commodities analysis and, of course, prices expectation as well. We'll hope to speak to you very, very soon yet again, because there's just so much happening in the international markets. Would be very, very helpful. So that's the view coming in from Goldman Sachs. Gold prices heading to 4,000, 4,300 perhaps in the next year as well. And the support in case of copper also is quite intact. But with that, that's all the time we have on this edition of Commodity Champions. Thank you for watching.